Welcome back, everyone. I'm Severino, your personal business coach. And today, on your journey to financial freedom, to a life where every day you get to do what you want to do, we cover an analysis of 21 assets with the goal to find the undervalued ones. You guys have been asking, Simon, okay, you have all these blue chips in your portfolio, but which ones are undervalued right now so that we can add them to our portfolio? We will go through 21 assets that I consider blue chip, and we will see which of them are undervalued and which of them are overvalued. Now, this is not financial advice. This is sharing my own process so that you can build a process for your decision making that really suits your current needs. First asset to analyze is Google. I am a holder of Google. I am adding Google whenever I can. We will apply the growth stock checklist and the fair value. Now, the growth stock checklist says that sales growth is super high, pricing power, meaning gross margin high and expanding, operating margin expanding, net income growth amazing, brand loyalty is there, team has shown that it is able to execute, quality, incentives. Is it a secular trend or is it a cyclical trend? It's secular. We're talking search and data. And then intrinsic value. The intrinsic value is also quite okay right now. So this is the relative valuation. Now let's go to the intrinsic valuation. Intrinsic valuation is a 94 out of 100, and the fair price is $152. Which makes it modestly overvalued from a price point. But I am an investor, so I put Google into my long-term portfolio. That's more than 15 years holding time. Now, when you look at 15 years, it's not very relevant if I buy it at $10 more or less, because in 15 years, this will have doubled probably 3 times. So, is Google currently undervalued? No. But would I put it in a long-term portfolio? Yes. Next blue chip stock is Salesforce, ticker CRM. For Salesforce, we have to apply a different checklist. Google was a growth stock at the moment when we analyzed it. Last week, it became a dividend stock. So from next week on, we will have to apply the dividends checklist. Salesforce is a dividend stock. We apply the dividend checklist. Low debt to equity ratio, yes. High return on equity, yes. High earnings per shares, yes. Moderate dividend yield, yes. Low payout ratio of that dividend yield, yes. Network effects, yes. Intrinsic value, fine. Team quality, amazing. Switching costs, really, really high. If you know any enterprises and you ask them, hey, would you like to switch your CRM? They will go, are you kidding me? That's so much work and so much risk. I'm not doing that. Barriers to entry quite high for enterprise CRM. And because of the distribution, not because of the product, there are much better products out there, but because of distribution. And now, so it's a 10 out of 10 on a relative basis. Let's look at the intrinsic one. The intrinsic one is an 89 out of 100, and the fair value is 246, which makes it slightly overvalued. Would I put CRM into a long-term portfolio? Yes, and full disclosure, I'm a holder of Salesforce. I even bought more this year, and I think it's a top software asset to have in a long-term portfolio if you're planning to hold more than 10 years. Next stock on the list is MSCI, something that I added recently to my portfolio. It was on my watch list because it's an amazing stock, but it was always overvalued. This changed after their last earnings report. So let's look at relative valuation. It's a 10 out of 10, low debt to equity ratio, high return on equity, high earnings per share, moderate dividend yield, low payout ratio. Absolutely yes to networks effect. Intrinsic value is great, team quality is great, and it's not even important because this business is built in a way that you could change the team every second week and it still works because the business model is so solid. Switching costs are very high and the barriers to entry are extremely high. So this is a stock that is actually also undervalued right now. Let's go to the intrinsic valuation. It's a 96 out of 100. And the fair value is $632, which makes it modestly undervalued. This is why I bought MSCI. And I should probably do a longer video on them. The short description is they are a data company, have almost no capex and no opex, and almost no risk, and a very strong strategic position, because every time a bank, a broker, a market maker needs data on the market, they have to pay either SPGI or Moody's or MSCI to get that data. MSCI, you might know it from the index ETFs. So MSCI World, MSCI Emerging Markets, those are index ETFs that are based on MSCI's data. And every time you, your cousin, your mother buys an ETF, that's using MSCI data, and many of those are, MSCI is getting some percentages of that transactions. This is the reason why I don't own ETFs, because I don't want to pay percentages for no value. But it's an amazing business model, because over the next 15 years, people will still buy ETFs. And every time they do it, this model will be reinforced. So it is at a fair value of $632, and it's modestly undervalued. Next blue chip is MasterCard. MasterCard is a 10 out of 10. Low debt to equity ratio, high return on equity, high earnings per share, moderate dividend yield, low payout ratio, networks effects, intrinsic value, team quality, switching cost, barriers to entry. Everything that you want in a stock is there. Let's look at the intrinsic valuation. It's a 97 out of 100 with a fair value of 464. It's right now at fair value. It has a lot of growth potential. I own more Visa than MasterCard, but MasterCard is an amazing stock and it's currently at fair value. Now let's go to Visa. Visa is also a 10 out of 10 in the same business that MasterCard is. And now many of you have asked, but Simon, banks are doing terrible right now. Should we exit the payment assets? Now, both Visa and MasterCard have nothing to do with banks. They are the networks that are used for the transactions. So banks are clients of Visa and of MasterCard. The vendors are clients of Visa and MasterCard. The users are clients of Visa and MasterCard. They are the network. It's the compute network, the network of relationships that's needed for the transaction. So couldn't be more different as a business model than a bank. And the risks are much lower. American Express is much nearer to the business model of a bank. Visa and MasterCard are quite the opposite. They reap the benefits of banking without having the risks of a bank, of running a bank. Now, Visa is at fair value. On a relative basis, I gave it a 10 out of 10. And intrinsic, it's a 97 out of 100 with a fair value around $278, which makes it fairly priced. So I have been adding Visa this month actually to my portfolio, and I plan to do so over the full year 2024 whenever an opportunity, a dip arises. Now, Amazon, one of my favorite stocks, it's ranking slightly less great than the others, but as a strategist, I am very bullish everything that's doing the right moves, and they are doing all the right moves. So we have to apply the growth stock checklist here because it's not a dividend stock. We have to look at high sales growth, yes. Profit, pricing power, yes. Gross margin, yes, expanding. Operating margin, not so great, but it's okay. Net income growth, yes. Brand loyalty, team, intrinsic value, it's a secular trend, incentives, and execution quality, all of that, yes. And when we say secular trend, Amazon is made of many parts. You have cyclical parts, like the e-commerce, that's cyclical, and also ads, that's cyclical. But for me, Amazon is really the cloud business and cloud plus AI. That part is secular, not circular. And that's for me the reason why I buy Amazon, actually. So a 9 out of 10 on the relative valuation, intrinsic 89 out of 100, fair value at 155, which makes it slightly overvalued for the short term, but in a long-term portfolio, I would love to have Amazon, the more the better. So I'm adding Amazon this year to my portfolio, and I'm ready to a currently already existing position, but I want to have more Amazon in my life this year. Xylem, Let's Solve Water. I have to make a separate video on Xylem. They are into water, and they are doing everything from collecting, purifying, distributing water. So that's a secular trend. We will need water over the next 15 years, and as a planet, we need good solutions for that. Relatively, I see 10 of 10 valuation. Intrinsic, 87 out of 100 with a fair value of 118. Currently slightly overvalued. I don't own it, but it's on my watch list. Fair Isaac with a 9 out of 10 has one of the most impressive business models out there. I think Fair Isaac and ASML have the strongest competitive advantage currently from all the assets that I've ever seen. But it's very overvalued. It's taking a hit right now, but it's still so overvalued. Let me talk about FICO in the next weeks and months, because right now it's completely overvalued. Hermes, one of our oldest core portfolio assets, 10 out of 10 on a relative basis, intrinsic, fairly valued, because with a 98 of 100 and a fair value of 2,519 for HESAF as a ticker symbol, I think it's at fair value and it has a long runway. It's kind of unstoppable. One of my favorite stocks. Bitcoin, we're changing genre. Now we are in the digital assets. With digital assets, there are no revenue streams, there are no cash flows. You cannot do a traditional intrinsic or relative valuation. That's why I've changed the valuation. I've created a qualitative/quantitative valuation of 10 things that I look at. So is the supply limited? Yes. Are the developer comments growing? Yes. Nakamoto coefficient going up? Yes. That's the number of nodes in a system. So is it decentralized or centralized? Network effects? Yes. Community? Strong. Team? There is no team. That's why absolute 100% yes. Incentives? Yes. All the shareholders and stakeholders are incentivized for it to succeed and not the opposite. Velocity? Yes. Competitive advantage? Yes. There is no competitor to Bitcoin right now. That would be gold. And yeah, it's by far not performing in the same universe. And then daily active users, yes, it's growing. You can look it up at artemis.xyz. You can see in real time number of daily active users, transactions, fees, numbers of wallets, so that you can still invalidate this. Next blue chip stock, a dividend stock, SPGI, similar to MSCI. Every time you buy the S&P 500 index, the data comes from SPGI. So it's the same model. What I love about it, low capex, low opex, almost no risk. What's the risk? Data is needed. And as long as you have high barriers to entry and high return on equity, high earnings per share, and high free cash flow, you are defendable. So with a 95 out of 100 fair value for SPGI, to me is $435, which makes it fairly valued. I think it's a great addition as a defensive position in any portfolio. Meta came out with Llama 3, which is an absolute game changer. It's faster and better than all large language models. It is open source as opposed to the other language models, most of them. And so it's open source, it's faster, and they have the number of users where you can immediately put it into WhatsApp, into Facebook. So on top of WhatsApp, on top of Facebook, you will soon be able to use a search field that's running on AI. It's running on Llama 3. They're working on Llama 4. I think it's a top blue chip stock to own. I sold Meta before the earnings call because I expected a dip, which happened. But I think it's still a great company. I might enter this year again. On a relative basis, it's a 10 out of 10. Intrinsic, we are at 87 of 100 with a fair value of $349. Right now, overvalued. That's why I sold, but I think it can be part of any long-term portfolio. It's a great company. Palo Alto Networks, 10 out of 10 on a relatively basis. We're talking cybersecurity, B2B, enterprise level. And then Intrinsic, 80 out of 100. Modestly overvalued with a fair value of 229. Still, I think they can be part of a long-term portfolio, planning to add this year when they dip. Subscribe to be informed when they dip. Adobe, 10 out of 10 relative, intrinsic 100 out of 100, and currently modestly undervalued. I'm not into Adobe because my focus is data owners with high pricing power. They have high pricing power, but not so much relevant data, but it's an amazing company, definitely one of the blue chips, and currently undervalued. NVIDIA is a 9 out of 10 on a relative basis. It's a 96 out of 100 on an intrinsic valuation. And the intrinsic, I think it is worth 727 right now. And of course, it's on a great trajectory. Only problem, and this is the reason why I don't own it, I sold it. The reason is the expectations are at 100 out of 100. And so, as you can see, I see it as a 96 out of 100. So if they have an earnings call and they only show 99, then they're below expectations. I don't want to hold all that risk. Is it an amazing company? Yes. Are you buying a lot of risk if you buy it right now? Yes. And you don't have to. You can have a relaxed compounding portfolio if you so want, and that's what I want. Netflix, 9 out of 10 on a relative basis, and intrinsic, 92 out of 100, fair value, 469, which makes it overvalued right now. Great company, doing great stuff, overvalued. The VICI is a Las Vegas REIT, a real estate fund. They have a 9 out of 10 because their contracts are very long, 42 years. Their tenants are amazing. They're MGM resorts. They own the best properties in Las Vegas, so it's a great company, and they gave a very high dividend yield, around 5%. Intrinsic valuation 85 out of 100. I think they are worth $39 and above, and they're currently trading below that, so they're undervalued. There I buy. They will not grow very fast, and I would only buy after we have an interest rate change, but it's a quality play. Evolution AB, they organize online gambling games like poker, blackjack, etc. And because it's online, they have software like Profit. So it's a 9 out of 10, and it's very undervalued. It's on an intrinsic level, they're a 99 out of 100, and their fair value is 182. They are far below the fair value right now. So I think they are significantly undervalued. The market does not really look at Evolution AB, company from Sweden that's run really well, that's in a sector that's growing, has a few risks. The only risk is really regulatory, but they know about that and they can work with that. And it's significantly undervalued. Let's skip HubSpot because it's too risky, I think. Yes, there are talks of HubSpot potentially being bought by Google, but it has only a 6 out of 10, so it's not a blue chip anymore for me. Tesla, 8 out of 10. It's also on the cusp of not being a blue chip company anymore, but there is this factor, the Elon factor, right? He seems to be able to pull things off that are actually impossible, but he did it a couple times. We, in our public portfolio, we doubled our money 3 times already with Tesla. Right now, it's painful to hold Tesla because they have a lot of self-inflicted drama that it's not great to have as a shareholder. So 8 out of 10 right now, but I'm still holding. I'm not adding Tesla because the position is already huge, but I'm holding. 83 out of 100 from an intrinsic valuation, and it's a possible value trap. With Tesla, you are in high risk, high drama territory, so only do it if you think, like I think, that they will be winning in multiple S curves, not just car, but also energy, battery, and robotaxis. Now, but that is to be confirmed. Then the last digital asset is Solana, but I wouldn't call it a blue chip. It's more of a trade for me. We are up 800% again on Solana, so it's a great trade, but it's not a blue chip for a long-term portfolio. Still, if you're into digital assets, I think it's a 9 out of 10. It's the strongest L1 from all. You can look at daily active addresses using real-time dashboards like Artemis.xyz or Dune Analytics, and you can see that it's outperforming all the peers in the L1 category at basically all of the time. And if that changes, I will be the first one to share it with you. So make sure you subscribe and hit that bell notification, because whenever something fundamentally changes in those 21 blue chips that I've just shared, I will be the first one to tell you, because most of them are in my portfolio or on my watch list. So I'm very aware of every change that happens there, and I can report to you. If you want live trade alerts, join our private mastermind. It's at strategysprints.com/JVC, where I share the exact limit orders and I share them live whenever I do them. Keep rolling, everyone. See you in the next video.